Could we see interest rates as high as 8% by the end of 2022? Last week, we saw interest rates rise the most in 1 week than we've seen since 1994. That's 27 years ago. So in today's video, I want to talk about the outlook for interest rates, where we'll be by the end of the year. In fact, I just did a survey on my channel asking viewers where they thought interest rates would be by the end of 2022, and the majority of you out there think interest rates will be somewhere between 5 and 6%. As of today, we're sitting just under 5% for most well-qualified buyers out there. So many viewers out there are expecting interest rates to increase even further and stay there for the next 9 months. So in today's video, I want to talk about why we've seen this rise in interest rates. Why now? Talk about what it looks like in a couple of months and how it's likely to impact housing as we move through 2022. Now, to understand what's going on at the moment, you need to understand the Fed's job, their policy. What are they supposed to do? So part of their policy is to set the overnight lending rate in which banks borrow from one another. That's the rate that you're hearing about in the market at the moment, the Fed funds rate. In fact, they just increased that Fed funds rate for the first time since 2018. And we're going to talk about how that impacts interest rates here in just a minute. But the other part of their policy is deciding on how to buy certain types of bonds. And in addition to those certain types of bonds, U.S. Treasuries, you have mortgage-backed securities. And mortgage-backed securities directly impact interest rates. At the beginning of the pandemic, what we saw the Fed drop the Fed funds rate, that overnight lending rate, to basically zero. And that helped stimulate the economy because it gave banks the option to borrow money at basically zero, at near nothing, which helped stimulate businesses, put money in the economy. In addition to that, they agreed to start buying bonds and mortgage-backed securities to the tune of $120 billion per month. And with all this stimulation in the economy, it brought interest rates down. And with interest rates down, money was very cheap. Supply was already starting to dwindle on the housing market side, and this added fuel to the fire. It gave buyers more purchasing power, and because of the lack of supply and all of the people out there migrating, moving out of state, being able to work from home, just changing, their daily patterns, if you will, due to the pandemic, it stimulated, house buying and created this frenzy with regards to housing because money was so cheap. But what we saw was because of the cheap money, in addition to the government putting stimulus checks into the economy, giving PPP loans, all of this stuff that happened, it created inflation. And that inflation was exacerbated by supply bottlenecks, all of these different factors in the market. And while inflation was rising, the Fed just kept saying it was transitory, that it was temporary, that it wasn't going to be sticky, if you will, and that it would subside. And therefore, they didn't do anything. They didn't change their policy. They didn't start to raise the Fed funds rate or taper, their bond purchases. They just let the economy do what it was doing, and inflation continued to get out of control. So that brings us to November of 2021. In November of 2021, the Fed came out and said that they were going to start to taper bond purchases, and they were going to start to slowly get rid of that $120 billion a month of purchases. They were going to get rid of that. And the market didn't like that, right? Because it was a little sooner than the market thought. And when the Fed makes decisions that the market's not expecting, it tends to have an impact on interest rates. And that's exactly what happened. And then December came around, and in December, they said that they were going to actually taper at a faster pace than they had originally quoted. Now, this wasn't going to be the end of the world because they would be investing previous investments from previous purchases. So the market continued to move on. Interest rates were creeping up, if you will. And those reinvestments are what helps keep interest rates low. Think of it like this. The Fed loans money out, and you pay your loan every single month with the interest, if you will, and then they take that money and then they reinvest it to someone else looking to borrow money. But what happens is when the Fed stops doing that, you just pay them your payment, if you will. Now, this is on a much grander scale, really talking granular here. When you pay your monthly payment, if you will, or those interest payments, banks pay those payments back to the Fed, and the Fed no longer takes that money and relends it out, that starts to affect interest rates. And that's exactly what we saw happen, which basically takes us into January, where they released their Fed minutes and more or less said that they were going to, finish up the tapering by March. And that's essentially what they've done. So, from November to March, very, very fast, the bond purchases ended. And in March, we saw the Fed funds rate rise 0.25%, while many people out there were hoping for 0.5%, but they released 0.25%, and the market, didn't really move, if you will, because it was kind of built in to what was happening. The Fed had already released a statement essentially saying that they were going to come out and raise it 0.25%. So they did exactly what the market was expecting. But here's the caveat. Just a week after raising it 0.25%, the Fed basically came out and said, whoa, inflation is way hotter than we thought it was, and so we're going to have to get more aggressive. Now, this was a change in policy because, just a week prior they had only raised it 0.25. Now they're coming out a week later saying it's way worse than they thought. The market didn't like that. And therefore, we saw a huge change in the expectations of traders out there in the market. And with the Fed coming out and making that statement, the market didn't like it. In fact, traders have kind of changed their stance on where they see the Fed funds rate at the end of the year. In fact, Citibank came out and said that they could see the Fed funds rate as high as 3.5%, which is nearly 1.25% above this chart here that shows, what traders have been expecting in the market. And in order to accomplish this, the Fed has to raise 8 times just to reach 2.25% by the end of the year. Guess what? There's only 6 meetings left in the year, which means in order to accomplish that, they would have to do some half-point raises in the market. And many people out there are expecting the next adjustment in the Fed funds rate to be 0.5%, followed by another 0.5%. And the idea behind raising the Fed funds rate is it helps combat inflation, which is exactly what they're trying to do. But since they've changed their stance on the policy or what have you and said they're going to get more aggressive, what we've seen is actually the 2-year and the 10-year invert. Now, many people out there are following this because what happens is when the 2 and 10 invert, you typically see a recession. And that's exactly what people are expecting, a recession to come. So going back to 1900, the average recession has happened 22 months after that 2 and 10 have inverted. But the last 6 recessions have ranged anywhere between 6 months and 3 years. So the idea of a recession coming, the probability is very high. And with the Fed funds rate up and a recession coming, all of this is deflationary, which should bring inflation down. But what does this actually mean for interest rates in the future if you're out there buying a home? So you know why interest rates have risen. It's because of the volatility in the market. And we didn't even talk about Ukraine and Russia and how that's impacted inflation in different ways. But the idea is that you have inflation out there. They're currently playing catch up because they should have started to raise the Fed funds rate and probably taper bond purchases back in 2021, but they didn't do it. And typically the Fed gets way more aggressive than they should. And that's essentially the prediction, if you will, of many people out there, is that the Fed is going to get way more aggressive than they should, and which is going to help, if you will, lead us into that recession. But what does the market look like? Well, typically speaking, when the Fed does what the traders out there are expecting, the predictions in the market, if you will, the interest rates don't really change in that environment because it's already built into what has happened. A lot of what we're seeing in interest rates is predicated on the Fed actually doing what they say they're going to do. So if the Fed comes out and does exactly what the market is expecting, if you will, you're likely to see interest rates stay the same. In some cases, pull back, especially if inflation numbers start going down. You're likely to see interest rates pull back a little bit, maybe not to the lows, maybe not sub 4%, but if we're currently sitting at 5% and interest rates pull down to 4%, that's a positive thing, especially if you're a home buyer out there or somebody looking to take advantage of the market. But it also is a catch-22 because if interest rates come back down, that essentially helps stimulate housing again to some extent, which could keep this craziness moving forward. But if you want, if you're a buyer out there and you want supply to come to the market, you essentially want interest rates to kind of stay high, at least for a period of time, to allow supply to build. But many buyers out there don't want high interest rates, right? They want lower interest rates and they want the property. They want their cake and eat it too, if you will. And that's very difficult to accomplish in the environment that we're in at the moment, because I think if you see a pullback in interest rates, you're going to see housing continue to do what it's been doing. But I think if interest rates stay up where they are now, maybe even a little bit higher, it at least slows the market a little bit, which allows some supply to build, which keeps housing moving, maybe not at the pace that it was, but you're not likely to see any huge crashes because, supply is still staying low in many, many markets out there. And with interest rates rising, it's likely to keep some homes off the market because sellers don't want to sell their home and replace their current 3% mortgage with a 5% mortgage in many cases. In fact, I ran some numbers in a video that I did about a week ago. If you were able to buy a home this time last year, a $500,000 home at 2.75% interest rate, that same home today, with home prices increasing nearly 20%, that home is now $600,000, but interest rates are almost 5%. That same payment, 58% more expensive today than it was just a year ago. So when I say interest rates need to stay high, it's because it affects affordability out there and allows supply to build. But it also hurts those sellers out there that were potentially looking to sell because now, they're in a predicament where the house that they might have to buy is way more expensive. So they might just stay put. So all of that is going to play into the direction of housing. But what I can tell you is that if the Fed comes out and does what the market is expecting, you're not likely to see any huge jumps in interest rates, right? You're more likely to see stabilization, maybe even some potential pullbacks, especially if inflation numbers come down. But if you're out there watching this video and wondering, how high interest rates continue to impact the housing market, I have concerns on that, and I talk about it in this video here. So do me a favor, check that out. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.